Assalamu alaikum dear students. Hope everybody will be fine. In the last lecture we completely discussed the concept of YTM, yield to maturity, and we also solved practical question on it. So this is a question which I am giving you for the home practices. The face value of the bond is 1000, redeemable after 4 years at $1200, and the coupon rate is 8%. So determine the YTM if the present market price of the bond is 1050. The same like question I solved for the 3 years, now you will solve it for the 4 years. Formula I have given that YTM is equals to LDR. LDR means low discount rate plus IV8 LDR, intrinsic value, IV that is intrinsic value at low discount rate minus MP market price divided by intrinsic value at LDR low discount rate minus intrinsic value at higher discount rate multiplied by high discount rate minus low discount rate. This is the formula. So in this formula you will put the prices after the calculation and will finding out the YTM, just like I have solved the previous question like this one. Here the coupon rate 8% is given, so you will suppose to be more than 8%. We'll finding out the two value which are near to 10 and 50. We'll apply the different rates through by trial and error based method, and you will solve this question and will send me your full calculation solved question in the WhatsApp group. Our next topic, that is types of the credit instruments. So credit instruments, these are the main factors of the financial markets. First one, that is simple loan. Simple loan in which the lender provides the borrower with an amount of funds which must be repaid to lender at the maturities. Simple loan, that is an instruments of the credit markets which has been taken by borrower either for short period of time or for the long period of time. It shows what amount of interest has been paid for particular time period, and after that particular period of time the borrower must repay that loan to the lender with some extra amount, that is called interest. Second one, types of credit market instrument is fixed payment loan. As its name indicates, fixed payment loan, or this is also called fully amortized loan. In this type loan, the lender provides to borrower with an amount of the funds which should be repaid by the borrower by making the same payments every month. The difference between the simple and fixed payment loan is that in fixed payment loan the fixed amount which had been paid by borrower for the particular time durations fixed payment has been given by the borrower to lender during fixed period of time, and in this payments some portion of the loan amount and some portion of interest that are repaid back by the borrower. For example, let's suppose if I take loan of $1 lakh with 10% interest, so I will return monthly wise the 10% per month amount of interest plus some percentage of fixed amount of the capital amount, borrowed amount as well as. So when maturity of that loan comes, so total loan are returned as well as interest is. So this type of the loan, that is called fixed payment loan or amortized loan. Like look at, we take car financing. So car financing is just like a fixed payment loan. How? When we take the car, so let's suppose the car price is 10,000 and we pay 15% per annum interest on it, and we promise that we will pay this total amount for 10 years. So we will pay back the car capital price, fixed price, like let's suppose $1,000 per year, and the interest as well as. So this type of the loan, that is called fixed payment loan. Next one, the credit market instrument is coupon bond. So coupon bond is the payment received by bondholder when there is a maturity of the bond. In bond, there is never mentioned the name of the holders. So coupon bond pay the owner of the bond a fixed interest payment every year until its maturity, and when its par value is repaid, so that is called coupon bond. Consort or perpetuity bond, so that is the type of the bond which is issued and with no maturity dates and the no repayments of the principal amount or principal repayments. Consort originally short for consolidated annuities, but subsequently take to mean consolidated stock. That name, consort name, was given to certain government debts issues in the form of perpetual bonds redeemable at the option of government, and they were issued by, for the first time, the Bank of England and the US governments. The first British consort bond were issued in 1751. Nowadays, dear students, the consort bond are fully redeemed. In case of consold bond when that is issued. So only coupon that are given to the bondholder, and the no repayments of the principals are offered to the bondholders. They have no maturity until and unless the corporations are in operating positions, so the bondholder will get the coupons. Next one types of the credit market is discount bond. So discount bond is a bond that is issued at lower price than its par value, or a bond that is trading in the secondary market at a price that is below the par value. It's similar to a zero coupon bond, only that the latter does not pay interest until maturity. A bond is considered to trade at a discount when its coupon rate is lower than the prevailing interest rate. When an investor purchases a bond, so he or she expects to be paid interest by the bond issuer. However, the value of the bond is likely to increase or decrease with changes in the market interest rates. If interest rates go up, it results in a decline in the value of the bond. The bond must therefore sell at discounts. Hence the name discount bond. The discount takes into account the risk of the bond and the creditworthiness of the bond of the issuer. A discount bond, dear students, is offered at a lower price than the market rates. Buying the bond at discount means the investor pay a price lower than the face value of the bond. However, it doesn't necessarily means it offers better returns than other bonds. Let's take an example of the bonds with 1000 face value. So, dear students, if the bond is offered to you at 970, their face value is 1000. But if that is offered to you on 970, so it is considered to be offered at discount price. Why? Now you are purchasing the 1000 face value bond on 970. And if the bond is offered on 1020, in more than their face value, it is considered to be offered at a premium. So premium price and discount price. If market price, offer price is more than the face value, that price is called premium price. And if the bond price is less than the face value, so this is called discount price. So bond trade in the secondary markets and their prices change with the change in the market conditions. However, the par value will still be repaid to investors when the bond reached to the maturity. So discount bond is what? That bond which is sold out or traded in the market at lower than their face value. So such bond is called what? That bond is called discount bond. So dear student, hope you will understand the credit instruments of the credit markets. Next one topic is the current yield. So the current yield of a bond is calculated by dividing the annual coupon payments by the bond's current market value. Current yield represent the returns an investor would accept if he or she purchased the bond and hold it for the year. So after 1 year, how much coupons they are receiving. So if we divide that coupon by the bond price, so whatever the answer will come, that is called current yield. As you know, dear students, the current yield and yield to maturity formula both may be used to calculate the yield of the bond. Each method has a different applications, and depending on the investor's specific goals. Bonds, dear students, are the debt instruments, so that pay interest to investors, who essentially function as creditors to issuer. These interest payments constitute a bond yield. It means that the interest on the bond which is paid after 1 year, that is called the yield of the bond. A bond current yield is an investment annual income. It's including both the interest payments and dividend payment as well, which are then divided by the current price of the security or the current price of the bond or the stock. But on another side, yield to maturity is the total return that is anticipated on a bond if the bond is held until its maturity date, or we can say that maturation dates. As you know, dear students, when a bond is issued, I'm explaining you with a simple example. So the issuing entity determines its duration, that for how much duration I am issuing this. Similarly, they are determine the face value, that is also called par value, and also determine the rate of interest that it pays, or coupon rate. In 3 things they are determining: the face value, the interest rate or coupon, and maturity or durations. These characteristics are fixed. They are remaining unaffected by the change in the bonds market. If any change comes in the bond market, for example, in bond market the prices are increase or decrease, interest rate are decrease or increase, so they are not affecting on the already issued bonds. For example, a bond with the par value or face value 1000 and 7% or 8% coupon rate. So pay interest 70 or 80 annually, and their maturity is, let's suppose, for the 5 years. So these three things, the par value, the coupon rate and maturity, that is fixed. So the current yield formula is the coupon or the annual coupon payments divided by the bond price. So on this way we can finding out the current yield of the bond. Yes, simply we can define that the current yield of the bond is calculated by dividing the annual coupon payments by the bond's current market value, because this formula is based on the purchase price. Rather than the par value of the bond, it more accurately reflects the profitability of a bond relative to other bonds on the markets. The current yield calculation helps the investors to drill down on a bond that generates the greatest returns on investment each year. Look at, for example, if an investors buy 6% coupon rate bond with the par value 1000 and they purchase it for the discount price 8,900. The investor earn now annual interest income 6%, and that 6% will be applied on the par value, not on the discount price or market price. In a $60 they will get interest. So the current yield is now $60 divided by 900. Clear? I will locate here. Let's suppose the bond, I will explain this with practical example now. Bond face value, that is equals to how much? 1000. Clear now? Interest rate, that is equals to, let's suppose, 6% per annum. Clear? And their maturity is, let's suppose, 5 years. And we purchase this bond on discount price, purchase price or market price. How much? Is equals to, we purchase this bond on 900. So now we are going to calculate the current yield. Look at, dear students, we keep this bond for 1 year. Now after 1 year we are calculating that how much yield we get. Yield means return from this. So if, look at, the interest will be calculated on face value, not on the market price or discount price, no. So look at, in this case the current yield is how much? How much? So formula is current yield is equals to annual coupon, annual interest divided by bond price, purchasing price. So how much is annual interest we earn? Annual interest should be calculated like, look at, I am calculating here the annual interest, 1000 multiplied by 6%. So that is equals to what? $60. Clear? Now, so annual coupon is $60. In here we write the $60 divided by, what is bond price? We purchase the bond price on how much? 900 on discount price. So look at, this is how much we get. So we will convert it into percentage. So that is equals to 6.67. This is what? This is the returns, current yield. This is current yield. Hope you will understand. I will explain again this one. That what? Here formula is coupon, interest divided by bond price. So the current yield in this case is how much? 60 divided by 900, which is equals to how much? 6.67%. The 60 is an annual interest that is fixed regardless the price paid for the bond. On the other hand, an investor purchases a bond at a premium price, 1100. So the current yield in this case will be less. Why? Look at, instead of this discount price, we purchase on the 1000 bond on 1100. So in this case, what will be the current yield? So look at, annual interest is 6%. 6% will be applied on their face value, that is 60. Clear? And 60 divided by, now here in this case 60 is our annual interest divided. What is the bond price now? So we purchase the bond on 1100 instead of 900. So 1100. Now the interest rate, the current yield rate will be less, 0.045. Yani it shows that 5.45%. And here this was how much? 6.67%. So in this case, at premium price, the current yield is decreasing, 5.45. Clear now? So hope you will understand the current yield concept. Yield on discount. So I will also discuss this topic, but in the upcoming class inshallah with example. So hope you will understand. If you have any problems, so kindly ask questions. I am adding with you people in your groups, so kindly you can ask the questions to clarify your mind. Inshallah, we'll see you in the next class. For now, Allah Hafiz, have a good time.